So finally, I'd like to introduce to you Paul Fineman and Giles Willits from IG Design Group. IG Design has a market cap of £270 million, and we've seen the share price rise around 30% over the last 12 months. IG Design Group is a progressive client. Hopefully you have some recent notes to hand on your seats, and there are a few spare at the back if we're short. The management team will tell you the story fully, but suffice to say that in our opinion, it's a well-positioned business in the market for almost everything gift and greeting related. The range of products is large but well managed, and the attention to detail I think is crucial in driving out good and reliable margins at very high scale to exacting customer requirements on the global stage. So it's a difficult business, but the management team have delivered very well in recent years. Paul Fineman has been with the group since 2005 when he joined as the CEO of Anchor International and has been Group CEO since 2009, being the winner of the QCA Award of CEO of the Year in 2017. At the other end of the tenure scale, we also have Giles Willits, who joined at the beginning of this year, so very new to the group, but with a wealth of experience from Entertainment One, where he was Group CFO for many years, and valuable history at Sainsbury's and Woolworths prior to that. So hopefully a balance of longevity and experience and some interesting new ideas from a new CFO. So it's a pleasure to introduce to you this evening Group CEO and CFO Paul Fineman and Giles Willits.
Good evening, everybody. I guess one look's worth 1,000 words. So to start off, we have a 3-minute video to give you a flavour of what we do.
At Design Group, we create 30,000 different products like these each year for our customers around the world. This is the story of just one of them. This is gift wrap. It transforms the products we buy into the gifts we give. But have you ever thought about how it gets made? Or who designs it? Well, it all begins at a design studio like this one of ours in the UK, with someone like this. Meet Julia, one of our very talented in-house designers. Before Julia and her team create any new design or product, they need to truly understand our customers' target audience. So, our first step is to research. Julia looks into relevant data, including design and product trends. These help us learn more about the consumers who buy our products from our customers' stores. And once Julia is confident that she has all the information she needs, we then put these findings into a presentation to share with someone like Sally, who is part of the buying and product design team for one of our long-standing customers. It's always helpful to talk through design concepts with Sally because she gives us her own insight and feedback and helps us all ensure further success. It's at this point where Julia can go away and work up the final design. Like many of our creative team, Julia loves using different techniques to produce great designs. From the more traditional of tools to state-of-the-art new technologies, like our own bespoke global live archive known as the Digital Asset Management System. This gives Julia exclusive access to hundreds of thousands of pieces of inspiration and artwork from around the world, all at the touch of a button. After the final touches are applied, the design is complete for Sally to green light. And once she gives us a go-ahead, it's time for printing. Meet Rob, one of our printing experts. Rob has the responsibility of operating one of these, our latest high-speed, high-quality, environmentally friendly printing presses. At peak times, this machine alone can print 600 linear meters of gift wrap a minute. And it's Rob's and the print team's job to check everything runs smoothly and to print our designs to the highest quality standards. The wrapping paper is first printed onto what we call jumbo reels, each one weighing in a whopping 500 kilograms and holding up to 12,000 meters of wrap per reel. Yep, that'll wrap a lot of presents. The next step of the process is to turn these jumbo reels into individual consumer rolls, which are then labelled ready for our customers' stores. These consumer rolls are then loaded into retail display boxes, which are then made ready for distribution. When the gift wrap leaves one of our manufacturing facilities, it gets shipped to our customers' distribution centres around the globe before going on display in their stores, ready to help millions of people transform the products they buy into the gifts they give. And just think, if you're impressed with the work that goes into one roll of gift wrap, imagine how much effort goes into the other 30,000 products that we create for our global customers every year. And that, as they say, is a wrap.
So just a view of what we do. And I'd like to really start off by saying that the group has really transformed in the last a decade, really. And I became CEO in January 2009. It was a pretty tough time then. And let's just say there were plenty of opportunities to improve our performance. And I'm very pleased to say that we have done since that time. So how have we done it? At that time, gift wrap manufacturing was the vast majority of our activity. Roughly 70 to 80% of all revenues were sales of gift wrap. And most of those, again, roughly 80% were in the UK market and were very Christmas orientated. So you can imagine that we had very many of our eggs in very few baskets. So we really transformed that. Rather than just being a gift wrap supplier, we became a gift packaging supplier. So bags and tissue and tags and ribbons and bows. And then we expanded that to what we have today, which is a celebrations business. So how we describe our business is everything for a celebration other than what you eat, what you listen to, and what you wear. We supply everything else. At our heart, we are a supplier of complex solutions to our retail customers around the world. And design, particularly what we would call commercial design, that's design with products that sell through, is at the heart of every one of our product categories. So we expanded from the celebrations business into stationery and creative play products. That would include design-led stickers and colouring books and design-themed collections, rather than the more commoditized staples and rulers and erasers. And onto other categories of products, gifting. So that would include ceramics and tinware and many other types of product. And finally, a relatively new category for us, which is not for sale consumables. So rather than bags that a consumer would go into a store and buy to present a gift in, this would be for the fashion and cosmetics industry. Here you can see some product that we just made for a brand called Giles. And that's a relatively new market for us. So we've really diversified over the last number of years. And again, a sense of the scale of what we do. We're selling approximately 600 million units of products a year. So if you look at our financials, which Giles will go into later, that means our average selling price is around 53 pence. Gareth mentioned about how important attention to detail to us. A penny is a lot of money to us. And the average retail price will be between £1 and £2. This has been an area of the market which has been incredibly resilient and strong over the last number of years. We are number 3 in the world market if you describe that market as greetings and gift packaging product. Within that, the largest player would be Hallmark, probably the only really well-known consumer brand worldwide. And the second player would be American Greetings, which actually recently sold. The difference between their business and ours, in fact, it's a sort of a mirror position. Approximately 90% of our products are non-greeting cards, whereas 90% of their products are greeting cards. We have 10,000 customers worldwide. We are dealing with the major global retailers, or in some markets or channels, we're dealing with distributors. So our business, as I said, has completely transformed. Geographically, the UK, which incidentally is larger than ever before, is 27% of our sales. The numbers that we see here are revenues by destination as at the end of March 2017. Our largest market is the United States. As it happens, it's also the market where we have the smallest market share. In approximate terms, our UK market share is approximately 40%. That's a high market share. Whereas in the United States, it's closer to 20%. I mentioned before that the majority of our activities used to be in the Christmas market. Christmas is still the single biggest occasion and celebration, but now it's only 57% of our sales. And in fact, some of the biggest growth is coming in at non-Christmas occasions, including Valentine's, or in recent years, Halloween has been a tremendous growth area for us in the UK. One of my first questions as Group CEO was, why are we making what we make? Unless manufacturing gave us a sustainable competitive advantage, we chose to outsource, and that transformed our working capital management and our margins. And finally, in terms of brands, approximately half of what we do is under our customer-owned brands. Half is under our brands, which we sell on a global basis. They would include a brand called Tom Smith, where we have the Royal Warrant. We supply under the Royal Warrant Christmas crackers and also gift wrap. And it's a big marketing tool for us, and particularly popular through Commonwealth countries, but also growing in the Far East too. So who are our customers? Our largest customer in the world is Costco. And we're supplying Costco, I believe now, in 16 different countries. There are actually very few retailers who actually buy on a global basis. For example, if we take Walmart, easily the world's largest retailer, I believe their sales are now approximately $500 billion. They act regionally. But if you win business within America, you will become a recommended supplier to Asda in the UK or to Walmart in Brazil or Mexico. But there's no inevitability that you'll get the business. The only other retailer other than Costco who are really acting globally are probably IGR. But the big growth stories, and you're probably very familiar with them, companies like Aldi and Lidl tend to buy regionally, not globally. But we are supplying, in the UK, you'll see our product in Poundland and you'll see our product in Harrods and Selfridges. So the top 10% in terms of upscale retailers is where we tend to seed innovation, and that will cascade into new markets in ensuing years. So our products are present in 200,000 stores worldwide. So if we didn't grow our customer base and we didn't grow our product base, and we are growing both, we can grow organically with the footprint that we have won over many, many years. So why do our customers do business with us? Well, it's a whole portfolio effect. As I say, we manage complexity very well, and it's difficult to do. And if it's hard for us, it's impossible for a lot of our competitors. So the breadth of offering is very, very important. And in the last number of years, we've really grown by offering a broader base of product categories to those customers. They are growing. We decided 8 or 9 years ago to work with those retailers who we thought would be the winners. So we were there at the outset, really, when the dollar stores grew in the United States. And again, to get a sense of that, in the UK, the pound shop business, which would be Poundland and Pound World and retailers like that, have around 1,500 stores. In the United States, the top 4 dollar retail groups have over 40,000 stores. And we've really grown as they have grown over the years. Design and innovation is key, but as I say, it's not about winning design awards, which we do, and that's good for the ego, but what's really important is that our designs really do reflect the fact we understand our customers and we understand our customers' customers. We get the consumer, and year after year, the sell-through of our product is very, very strong indeed. Geographic diversity to be able to manage on a global basis, supplying Costco around the world is not an easy thing to do. Our customers have very exact standards and requirements, but the track record is very strong, and frankly, nothing succeeds like success. So we have to be competitive. That's a given. But if we have competitors who will try and chip away at our business or undercut us, it's very, very rare that we would actually lose business on price, because we're giving so much more than price. As it happens, in the vast majority of cases, we're extremely competitive too. Audit and compliance, I can't emphasize how important that is to us. We run our own manufacturing, including our own plant in China, where we're making Christmas crackers, we're making greeting cards, we make bags. And we have to comply with very demanding standards from our customers and from licensors. It's extremely important to us. If you walk into our manufacturing plants in the Far East, you'll see world-class standards. Customer relationships at all levels are very important to us. You saw in the video there that we have a very collaborative process with our customers. But don't get me wrong, none of them are pussycats. They're very, very demanding in terms of margins and service. And finally, we're a low-cost provider. We've invested very, very significantly over the last number of years, and we have a technological advantage through that investment. We're a real business with real assets, and one of the barriers to entry is just the sheer physicality of what we do. Giles will touch on it. There is also the fact that the need to finance working capital is a real barrier to entry. And it's what has really driven quite a lot of the smaller players out of the marketplace, particularly as the buying power has polarized over the years. So if we look at our financial year, and we'll be doing we'll have a trading update actually later this week. Our financial year ends at the end of March. What have we done in that year which has driven a difference and continued our growth? We invested in new product categories around the world, and you'll see that particularly in the United States, Europe and Australia, our growth has been underpinned through new product categories and innovation. Last year, we announced the fact that we would be putting our 3 UK businesses under one leadership team. We had a lot of the cost of that last year. This year, we will see that actually delivering tangible growth. We're very, very happy with that indeed. In terms of innovation, we have started a brand new business. That business actually has been accelerated through changes of legislation in the UK. As you may all be familiar with, the transition from plastic bags into paper bags has created a completely new industry and dynamic. We embraced that. We invested significantly in very environmentally friendly manufacturing over the last number of years, which includes audited sources for paper and non-solvent inks. So we really are on the sort of leading edge of that. In terms of acquisition, we've been active in the last number of years. We bought a business in the United States in 2016. It was our first full year in 17-18 for that business, and we will see the synergies that we planned delivered. We also bought a business in January of this year in Australia called Biscay, a greeting card business. We think that will deliver exceptionally good value, and we're already hitting the ground running. That will be fully integrated by the end of May. So we're very pleased with that. In terms of investments, you saw on the video the kind of technology we use to print wrap. We have a new generation printing press, which is now a grand 4 weeks old. which is up and running, and it's really incredibly impressive. It gives us new capacity and new capability in a market where we're growing our share. So we're excited about that. And finally, on the investment side, our business in the United States has approximately doubled in the last 4 years. And we are investing around $2.5 million. About half of that was in last financial year in a new IT platform, just to give us a slicker, faster, and a greater capacity in the United States. And with all of that, capital investment in place and a growing business, we are generating cash, increasing dividends, and we're in a healthy place. So that was a whistle-stop tour of what we've been doing in the business. Just to highlight two things. In terms of the new initiative, what we call not-for-sale consumables, that is an approximate £130 million at our selling price business in the UK. We feel confident that we will be able to take around a 7% share, so around about £10 million over the next 3 years. We've got a particular converting setup which takes advantage of the printing press that we've already put in place for printing gift wrap. And we're already at full capacity and considering a second line putting that in early next year. And just to say a little bit more about the business we bought in Australia, Biscay, this is a business which has a customer base of about 2,000 customers that we weren't trading with. There are obvious cross synergies there. As I said, it will be fully integrated by May. We acquired that business for 2.7 times EBITDA. And we think that was a very sweet and great value transaction. We perhaps won't get too many of those coming along, but we took advantage of that. We were nimble, we were quick to it, and we had that deal done very, very quickly. We're very happy with it. So without further ado, on the financials, Giles, over to you.
Relatively swift trot through the financials. Two things to bear in mind. One, these are now over 12 months old, so we have just finished FY18. We're actually looking at FY17's results here. Sorry, I can't give you any more precise numbers. I will give you a flavour by talking about consensus for FY18, which will give you a sense as to where we are. We did a trading update in January. We have another one this week. The one in January very much confirmed we were anticipating where we were going to be and in line with management expectations and so on. So when we talk about consensus, you can get the drift. What is great about this business from a financial perspective is the trend. And if we look at what's happened in the last 4 or 5 years, the growth of the business across all the financial metrics has been great. If we look forward to FY18, we're going to see continued progress. Consensus for sales is about 328 million if you look at the progressive numbers, 5% growth. That's going to deliver strong growth in terms of profit and also continue to see strong conversion into cash as well. And our net cash position, again, if you look at the consensus, will continue to be a net cash position going forward. So, and that's despite some increased levels, much higher levels of investment in CapEx and also that acquisition of Biscay that we did early in the year. So great trend and a continuing trend going forward. As I say, this slide's a little bit old, but certainly gives you a sense of how the business is growing. With strong sales last year, a lot of that growth coming from the US and Europe. Particularly pleasing was the performance in terms of gross margin and underlying margins. And that, again, is a story that we'll continue to see going forward. What I liked about this business when I was looking at it maybe 6 months ago before I joined was that cash generation, and particularly the net cash position. I love a business that doesn't have significant leverage, and this one doesn't. that just means we're in a great position for going forward, which we'll talk about in a minute. That average leverage of 2.3 times last year, that's average leverage. Obviously, we didn't have leverage at the year end, so our average leverage at 2.3 times last year, we'll see that significantly reduce. And when we talked about performance, and when you look at the consensus, when we talked about performance in January, we did indicate that that would be closer to below or thereabouts 1.5 times. So significant improvement in the year as well. Again, emphasize average leverage. And all of that's helping the progressive dividend policy that we've got. And you can see we had an increase last year. And again, we're consensus to improve that again. One of the strengths of the business is the geographic diversity of that business, and that comes through in the numbers. And you can see it here, strong growth across all the areas. And we've said again in our trading updates that we continue to see that going forward. We're looking at a margin there that's improving year on year, and I'll talk about it in a bit when we talk about the promises we make, but one of those is to improve our underlying margin in the businesses that we operate, in the business units, and aim to get to an overall margin of about 8% from those businesses. And we're making good progress last year towards that, and again, making good progress this year. It's not just about revenue and profits, we deliver EPS growth as well. And you can see there, we did a whopping 38% last year. And again, if you look at the EPS number in consensus this year, what Progressive have is 21.5p. And so in line with management expectations, that's another significant growth again this year in FY18. We will see dividend progression, as I've talked about, and again, we've got the consensus showing that going up again. And interesting, we talk about tax. Should we spend some time on tax? No, let's not. But one of the things about tax that is interesting, even for people who are less interested in tax than me, is what's happening in the US. We have seen an increase in our tax rate because of the mix of the profits that we get. More profits in the US last year meant this year, meant our tax rate go up. But obviously next year, FY19, with the reduction in the US tax rates, we're expecting our tax rates to go down. So a nice position to be able to tell you that we're actually seeing an underlying ETR going forward that will, effective tax rate, decreasing as we go forward. I mentioned it earlier, I love this slide because it shows the strength of the cash flow of the business. We have a saying in the business, which I've picked up, which it's not profit until it's cash. And there is a strong belief in the business to that saying and working to that ethos. And you can see it here exactly, EBITDA turning to cash. And we focus on that quite heavily in the business. This year, again, looking at consensus, you'd expect to see a similar conversion, and that's despite the fact that we've increased our investment in CapEx and we've had that investment in an acquisition as well. So a continuing story where we end up with net cash at the bottom line. Balance sheet, I won't spend long on. It's a very straightforward balance sheet. Two things to bear in mind. One is when we look at fixed assets, we do have a lot of freehold, and we announced last week or the week before, the sale of a part warehouse site that we have in Irvine, yes, where we will deliver an exceptional profit as a result of that coming through in FY18. The rest of it, you can see lots of things going on. We focus a lot because we have a focus on our working capital. We are keen to make sure that we manage that. The working capital in the business is very seasonal. If you look at the fact that we had we had cash at the end of the year, but we have an average leverage of 1.5 times or so during FY18, then you can sense that there's a much higher level of actual working capital in the business through the year. And there's a good example of that. Again, nice thing about this business is the low level of funding cost that we have, in addition to the fact that we've got low leverage and an improving leverage trend. We have very flexible facilities and they work very well for the seasonality of the business, which means that the underlying finance charge that comes through the P&L is low and a strength of the business, an asset to the business. So a quick meander to the promises that we make as a business, and these are promises to you as shareholders. We do promise underlying EPS growth. We look to have double-digit growth on a CAGR basis. We do look to improve the returns that we make to shareholders through a progressive dividend policy, and we do look to maintain a low leverage position and a de-risk position from a leverage perspective, and we look at 1.5 to 2.5 times. Clearly, if we were to do some either significant investment or acquisition, then we could see that go closer to the 2.5 times, but really we're looking to then pay it down and get closer to the 1.5 times. So we're trying to work within that range. We're going to get that from various levers, but these are some of the key areas that we focus on. Gross margin, as Paul said, every penny counts. We do look at improving our PBIT through efficiencies and scale, and then we do also focus heavily on return on capital employed. And that was me done, so that was quite quick, wasn't it?
So we spoke about the good stuff, but what is it that keeps us up nights? What are the challenges in the business? Every business has its challenges, so we thought we'd highlight those. As we've transformed in terms of how we either produce or source our products, we are spending more and more with third-party suppliers. So it's incredibly important that those suppliers are dependable, are reliable. We have a huge network of both quality control and quality assurance people in the Far East. We are always looking for a plan B and a plan C. I guarantee you that if suppliers give us problems, it will be in the peak season when we can really do lease with them. So we like to make sure that we are very well spread and we have deep knowledge of our suppliers' activities. So I think we're well placed. We give that a green light. Secondly, have a reliable customer base. What does that really mean? Well, of course, we like to work with growing customers, but actually we'd like to make sure our customers don't go bust. Our bad debt occurrence over the last number of years has averaged at 0.1%. It's never going to be zero, but we've walked away from some fairly significant contracts over the last number of years because we just didn't feel confident about those customers. I can name people like British Home Stores, for example, where we were trading maybe £1.5 to £2 million. We took that decision not to go ahead with that business unless they paid on a pro forma basis. So I would say we're conservative. You don't have to get too many of those decisions wrong for them to really bite you. Macroeconomic factors, we actually feel that when times are pretty tough, most of our customers do quite well. So we think that our products are resilient, and indeed there's a resurgence in terms of certain categories reverting to kind of traditional demand from consumers as well. So for example, if you take paper and printed products, puzzles are really a resurgent product category. Children's books are a resurgent product category. Not every parent wants to sit down and flick through an iPad or a smartphone with their kids. So there is some great growth for us in traditional categories. Cost headwinds, many businesses have suffered cost headwinds. It's not unusual for us to have to manage labour cost and material cost or foreign exchange volatility or sea freight, Uncle Tom Cobley and all. That's the normal challenges we have in business. The paper costs have definitely been a headwind and more pronounced in the last 6 months. But we hedge paper forward, we re-engineer, we've invested in efficiency, we've invested in innovation, and whilst that headwind has certainly been there, we are very pleased with how we've been able to grow our gross and net margins despite that being the case. And we believe that trend will continue. Foreign exchange movements, we're kind of naturally hedged. We do a lot of business in the States. We export in dollars, we import in dollars, and we hedge forward. And finally, people. It's all about people. And interestingly enough, when we look at our traffic light there, we would say amber. And my colleagues will say, well, why isn't it green? And I kind of tell them, well, it used to be red, so just keep on your toes. So why invest? I mean, clearly we've been a growth story, but I can assure you we're not a perfect business. There's lots of improvements still to be had. And as Giles mentioned, we believe that our net margins are on a very healthy journey through to 8% and beyond over the next 2 to 3 years. So we see steady top-line organic growth, and I know Progressive have stated in their numbers at around 5%. We feel very comfortable with that. We also see that there will be M&A opportunities, but we'll be very discerning. As I said before, we don't need another customer or another product category in order to grow. We don't need to buy businesses in order to grow either. But if there are very compelling opportunities, we've got a strong balance sheet, we've got a very capable management team with the bandwidth to take those on. So we are actively looking at M&A opportunities. As far as the DNA of the business, it will remain design and innovation. That's what we feel we're good at, we're investing in it, and it's the point of difference. If we ask what do our customers want us to be, they want us to be a market consolidator. They are reducing their buying and product development resources, and they're looking to consolidate their business with a trusted supplier. And that's where we will perpetually invest to make sure we're ahead of the market. We will continue with our mantra of it's not profit until it's cash. We will convert our profits into cash. We will progressively return more to shareholders. We will progressively invest. So if I look back, what's been 9 years, it's a very different phase of our business to when I first became CEO. We had a lot of challenges then. Now it's a whole different ballgame. The expectations are much higher, but frankly, it's more exciting. So that's our story. Thank you.
Hi there. I'm just looking at the Progressive note that's put out in November, and it talks there about different sectors and about the UK. And it seems that the UK is a sector that's under a lot of pressure, and that might well be structurally under a lot of pressure. And there are lots of headwinds discussed here, to do with cost inflation, falling sterling, that kind of thing, and also the rise of the discount stores. And I can see that margins have fallen from 8.6% to 8.1%, lower than any other region by the looks of it. Now, is this a structural problem that can be mitigated or turned around, do you think? Or is the UK going to be one of the most difficult markets for you going forwards?
Well, it's definitely a tough market, there's no doubt about it. However, we took a decision to reorganise the UK and to continue to invest in the UK as well. I feel very confident that our investors won't be disappointed with the outcomes this year and beyond. I think that the UK has been very difficult for us also in terms of growth. We have such a big market share here. Nevertheless, we will see growth once again. And I think that it doesn't have the scope for growth that, say, we have in the United States or even in continental Europe. Nevertheless, I think that the last few years, which have been, quite honestly, quite stagnant, we'll see a progress, I believe, and I don't think anyone will be disappointed. The work that we did to invest in restructuring is beginning to pay off, but I would say it's a 2 to 3 year cycle for that to really deliver.
Can I just ask as well, you talk about hedging and paper costs hurting and this kind of stuff. Now, is it the case that when, obviously, a lot of the business happens at Christmas time and clients are ordering ahead of time to be prepared, when they order, do they have essentially a fixed price that they're paying, and then you're then exposed to changes to paper costs and all these other things which you have to then hedge against? Or does the price they pay change?
Well, holistically, most of our Christmas business is not actually confirmed until post-Christmas, and we are hedging and buying our paper on a rolling basis. On average, we are covered 70% forward. I can't think of any major contracts where we're locked into a price and we're vulnerable to huge volatility. Eventually the markets catch up. That's what happens. And it's been difficult. The last 6 months in particular on paper pricing, there's been significant price increases. But overall, we have still managed to, through innovation and a number of added value services, we have been able to actually increase our gross margins. So we're happy with that. It's true, they may have increased more if it wasn't for the extreme volatility that there's been, but overall we're still in a pretty healthy position.
In view of the importance of the US market to you and also the successful sort of evolution of your Australia business, how stretched is senior management going to be to deal with those two markets and the difficult UK market as well?
Well, obviously we have a uniquely deployed management team with CEOs and CFOs per region. And I would say, are those people challenged? Absolutely. They're not sitting there twiddling their thumbs, I can assure you of that. But I think that we're well placed to ensure that our core business is looked after, and we've also invested for growth. Whilst our overheads have increased over the last number of years, actually as a percentage of sales, they've either been flat or they've reduced slightly, but most of that extra investment has been about the future and growing for the future. So we're very conscious of that. For example, we have a major investment in a new ERP, IT platform in the United States. That can be a big distraction. Putting that in and managing your core business and growing at the same time, you're spinning a lot of plates. How we did that is we brought in incremental, fully focused, either project management or incremental resource to keep that happening. And we have seeded new areas of growth, particularly in innovation, and we've written all that off in the year that it's incurred. So we're very conscious. It's a very fair point. When you've got a growth business with very demanding customers, you can't keep putting more and more through the same team. It doesn't work.
Just very quickly, you've got a fantastic customer list. Who are you missing that you want?
That's a good question. Well, in the UK, probably the standout absence there is Marks and Spencer, who are tied into a very long-term contract with Hallmark. In the United States, our focus, it's interesting because in the US, we've put a lot of effort into regional retailers. Some of the regional players there are bigger than our national players here. So I would say that's definitely a big area for us to expand in. In Asia, we have a relatively small business in Asia, but it's growing, but it takes a long time. We recently started doing business with a company called Daiso. In Japan, took us 3 years to conclude that business. It doesn't, culturally, it can take a long time to develop. Fortunately, the customers that we felt we should really focus on are all growing very well. Their organic store growth probably averages at 3 to 4% a year. So, if you think about that, that's 8,000 to 10,000 more stores for us to put our products through. We're growing our customer base all the time.
I'm interested in the possible impact on the business of increasing trade barriers. Is there a lot of import and export between countries, continents, and how would you be affected, and how will you manage it if it is?
At top level, at the moment, based on, if you think particularly about the US and the tariffs and the potential issues there, China, none of the product groups that we're working with are impacted by that. So from that perspective, we're not anticipating any big issues from that. At the same time, though, we're also, in the UK, we're manufacturing our own product in the UK, and Europe we're manufacturing our own product in Europe, and so on. So we are de-risked in some extent from that, and we've got the opportunity to do the same in the US, where we're looking at the potential for an investment in printing there as well. So there are levers that we can pull to ensure that we're not sort of suddenly exposed as a business to those sort of issues.
Thank you very much indeed, gentlemen. Very comprehensive and well within the limits. Thank you.